So we're looking at a week ahead that is shaping up to be a massive, high-stakes clash between two huge global forces. On one side, persistent inflation. On the other, slowing global growth. The data drops we're about to see could fundamentally shift how the world's biggest central banks steer the economy, and they might even dictate the trajectory of your portfolio for the rest of the year. Let's get into it. Here's our roadmap for today's tour of the upcoming economic events. We're going to cover the global policy tension, the US Economic Balancing Act, look inside Japan's rate debate, analyze oil supply and global risks, and finally, compare UK growth versus Canadian patience. Let's kick things off with Section 1, the global policy tension. What we're seeing right now is a really fascinating fragmentation. Central banks just aren't operating against a uniform backdrop anymore. Some are dealing with unexpected strength while others are starting to see real cracks in their economic foundations. And that brings us to the absolute core theme of this week's data, the inflation paradox. Basically, this is the ongoing tension between persistent inflation risks on one side and emerging evidence that restrictive monetary conditions are genuinely hurting labor and economic activity on the other. Policymakers are literally losing sleep over this. They're trying to figure out if sticky services inflation and supply constraints will keep prices high even as the broader economy clearly loses its momentum. Honestly, it's like trying to drive a car by slamming on the brake and the gas at the exact same time. That's essentially what central banks are navigating right now. Moving right along to Section 2, the US Economic Balancing Act. The United States is the absolute epicenter of this paradox right now. The labor market there just threw a massive wrench into the Federal Reserve's plans. Take a look at this number, negative 103,000. That represents some pretty substantial, very quiet downward revisions to previous US payrolls over a 2-month period. Combine that with a recent headline jobs report that materially disappointed expectations and an unemployment rate that actually ticked up to 4.1% and, well, things get complicated. This kind of unexpected weakness dramatically raises the stakes for the upcoming inflation data because it strongly hints that the Fed's restrictive rates are finally biting hard into the real economy. The labor market was supposed to be the absolute bedrock of the whole soft landing scenario, but now that foundation is looking a little shaky. But here's the so what bridge view. Despite those surprisingly weak payrolls, the underlying inflation metrics are still flashing warning signs. We're seeing the manufacturing prices paid index sitting at an elevated 71.1 and services at 70.3 in the latest July ISM reports. This means persistent cost pressures, driven by things like wage demands and supply chain friction, are remaining uncomfortably high. The Fed simply can't ignore this side of the equation. They're totally caught between a cooling job market on Main Street and red-hot input costs on the corporate side. Services inflation is notoriously stubborn because it's so tightly linked to wages, and as long as those numbers remain elevated, the inflation fight is definitely far from over. Now, what's really interesting about this is how it frames the upcoming July CPI report. It is the ultimate test for the Federal Reserve's September decision. Expectations are currently sitting at a 0.1% month-over-month bump for headline CPI and 0.2% for core, but you've really got to watch energy goods, which are expected to drop by 2.6%. That plunge might actually mask some of the underlying stickiness in core services that we were just talking about. It's a super wide range of plausible outcomes, meaning this single report might not settle the debate entirely, but trust me, it is going to be intensely scrutinized by every trading desk on Wall Street. They want to see if inflation is actually contained or just hiding behind cheap gas. And because of all this tension, market expectations are whipping around at lightning speed. Right now, there's a 53% implied probability of a 25 basis point rate hike from the Fed this September. What's absolutely incredible here is that immediately following that week's jobs report, this probability plummeted to 44%. But as investors kind of sobered up and remembered the Fed's primary mandate is to crush inflation, those expectations rebounded. The market literally doesn't know which way the Fed will jump. It is a true coin toss right now, which means this upcoming CPI print isn't just another data point. It's going to be a massive market-moving event. Let's pivot to Section 3, inside Japan's rate debate. Leaving the US and heading over to Asia, let's talk about the Bank of Japan. At the recent meeting, the BOJ kept rates unchanged. To see if Takoto's push for more tightening is just an isolated, outlier position, or if it represents a growing hawkish consensus that's quietly building among the rest of the board. Japan has been the global anchor for cheap money for literally decades, so Any hawkish pivot here sends massive ripples through every asset class worldwide. To really understand the mindset over there, we just need to listen to Governor Wade himself. He recently stated, "The central bank does not need to wait until the data demonstrate that inflation has completely stabilized to 2% before making policy decisions." And this brilliantly illustrates a massive shift. They're moving toward a proactive risk management approach, rather than just waiting around for backward-looking data to cross a fixed threshold before they do anything. They are getting ahead of the curve, sending a clear signal to markets that the days of guaranteed ultra-loose monetary policy in Japan are numbered. Alright, Section 4. Oil supply and global risks. Of course, none of these central banks operate in a vacuum, right? Energy prices are the common thread connecting all of them to external, unpredictable inflation shocks. Check out this note: 188,000 barrels per day. That is OPEC's nominal output increase for September, which officially completes the rollback of their 2023 voluntary production cuts. On paper, this is a very measurable step toward restoring physical supply to the global market. In a totally normal environment, this injection of supply should theoretically ease some global inflation pressure, giving our central bankers a little bit of breathing room when it comes to headline inflation. But physical supply is only half the equation here. You could be pumping out more oil to restore supply, but if Middle East instability and ongoing shipping route attacks disrupt the transportation of that energy, your effective supply is still highly threatened. I mean, it doesn't matter how much oil is coming out of the ground if tankers have to literally reroute around entire continents, driving up freight and insurance costs in the process. This complicates monetary policy immensely. Central banks have to figure out if sudden price spikes at the pump are the result of permanent domestic inflation or just temporary external shipping shocks. And remember, central banks can print money, but they sure can't print oil, and they definitely can't print safe passage through the Red Sea. Which brings us to our final section, Section 5, UK growth versus Canadian patience. We're going to look at two major economies moving in completely opposite directions when it comes to labor and growth dynamics. Let's start with the UK. Preliminary Q2 growth is expected to slow down to 0.4%, and get this, June GDP is expected to outright contract at negative 0.1%. The Bank of England is watching this closely. If this weaker domestic growth continues, it might finally justify a more sustained dovish shift, especially if those geopolitical inflation risks we just talked about start to fade. The BOE is walking a serious tightrope right now. If they cut rates too early, inflation reignites. Keep them high for too long, and they risk unnecessarily squeezing an economy that's already flashing contraction signals in the monthly data. But then, look over at Canada, plus 75,000. This was a massive, surprisingly robust employment surge that absolutely crushed the 12.5K expectation, and it actually lowered their unemployment rate to 6.4%. What's even more impressive is that this happened alongside a rise in labor force participation. It's a completely different picture than what we just saw in the US or the UK. It just goes to show how incredibly varied the global economic landscape is right now. So the crucial point is, we are witnessing an intense policy divergence. The UK is showing slowing momentum and emerging dovish impulses, while Canada boasts a robust labour market that affords its central bank the luxury of absolute patience. The Bank of Canada can literally just sit back, evaluate the incoming data, and weigh trade risks without any immediate pressure to aggressively act. They've built up a massive cushion for themselves, whereas the UK is feeling the immediate heat of potential contraction. As we wrap up this explainer, here are the key, actionable G7 indicators you absolutely need to have on your radar for the week ahead. First, we've got the US July CPI and retail sales. That's going to be the ultimate test for the Fed's next move. Second, keep a close eye on the Bank of Japan's summary of opinions to gauge just how hawkish they're getting behind closed doors. Third, the UK Q2 and GDP reports to see if they're slowing down enough to warrant rate cuts. And finally, keep a constant watch on global energy infrastructure risks, which could upset the entire inflation apple cart. These four pillars will absolutely define market momentum this week. Which leaves us with this final, provocative thought. Will this week's data entrench this global policy divergence, sending every country down its own unique path? Or will it reveal a new, unified economic reality, where the inflation paradox resolves itself globally? Keep a close eye on those numbers, because the delicate balance between inflation persistence and weakening demand is about to be severely tested. Thanks so much for joining me, and keep learning.